One of the most often asked questions is, what are the tax rules when it comes to selling one's principal residence or home? Ultimately, will I have to pay capital gains if I sell my principal residence? That's really the question. So I'm going to cover what taxes you'll have to pay when selling your home, but perhaps more importantly, how you can even avoid paying taxes on up to $500,000 when you decide to sell. Additionally, there may be some other ways to reduce your capital gains if done correctly. Now, if it's not done correctly, well, you may get this response from the IRS.
I'll be back.
Which is probably not the response you were looking for. So after explaining some of the requirements of the tax exemption, I will also cover an example that will help you determine how to calculate if you may have any potential taxable gain on the sale of your property. Now, my disclaimer is this video is intended for educational information only, and I'm not a tax expert, so always check with your tax expert for advice on your particular situation. I'm Harold Powell. I'm a local real estate agent serving Ventura and the surrounding community. So if you want to stay up to date on all things real estate for Ventura area, then I suggest hitting the subscribe and bell icon to be notified of future content. So let's address the first question of what is a principal residence as far as tax purposes go? Well, a principal residence is the dwelling that a person inhabits for most of the time. A principal residence can be verified actually through utility bills, driver's license, tax returns, or even motor vehicle registration. So the next question is, well, what is the ownership requirement to qualify for the exemption? So the home must have been used as a family's primary residence in the past 2 of the last 5 years. It cannot have been acquired through a tax-like exchange in the last 5 years. Also, it cannot have sold another property using the tax exemption within the last 2 years. So once you qualify for the ownership requirements, then there are 2 potential exemptions that will apply. One, for individual owners of the home, they are exempt from paying to capital gains on the first $250,000 of profit on a property. Now, while married couples are actually exempt from paying capital gains on the first $500,000 in profit in gains or profit. So capital gains tax is owed for the gains that exceed those numbers. No doubt, this is one of the largest tax breaks you can have when you come to selling your home. And there is no limit to how many times you want to be able to use this exemption. However, the only restriction is that you can only do this every 2-year period. Now, there are a few potential exceptions to the rule of selling before 2 years. You may be able to qualify for a handful of special circumstances, such as a change in workplace that requires you to move over 50 miles, a health-related move, or an unforeseeable event. Now, I suggest taxing with your tax professional if you are in an unforeseeable event. Now, the other question that comes up is, what if I move into my rental? Can I take advantage of this exemption? So my best answer to you is to suggest watching my video on converting rental to a principal residence to get a complete answer. Otherwise, when calculating the amount of gain, I notice that a lot of homeowners or sellers get confused and use their loan amount as their basis or starting point when determining the amount of potential gain. Now, the fact is the loan amount has no bearing on how to determine taxable gains. The IRS only cares about profit. So a real simple definition would be whatever you paid plus improvements minus what you sell it for. So the good news is those improvements that you've done can be added to your basis. So capital improvements are different than repairs. Improvements are items such as adding solar panels, replacing all the windows with dual pane windows, adding a deck, installing air conditioning, or remodeling the kitchen and bathrooms. Repairs would be things like repairing a leaky roof, removing mold from the attic, fixing an electrical issue, or just replacing smoke detectors. Now, the only time repairs can be used in the calculation of the potential gains is if the repair happens within 90 days of the sale. So let's take a look at an example on how to calculate the potential gains and use the exemption in each case. So in this example, use a seller that, let's say, purchased their home for $500,000. Since they bought the home, they did a kitchen and bathroom remodel, added solar, AC, and a pool to their home, which totaled $255,000 worth of improvements. Now, they are selling their home for $1.3 million. So let's take a look at this spreadsheet. So you're going to start by taking the sale price and subtract the selling expenses. So this gives you the amount realized, which is $1,212,500. Next, we need to determine the adjusted basis. The adjusted basis can be calculated by taking your initial purchase price. In this example, it's $500,000. Then we add the improvements made to the property, which was $255,000, plus another $3,000 in repairs made to the property in order to sell. This gives us an adjusted basis number of $758,000. Now we can calculate the amount of gain prior to the exclusion, which is the amount realized, again, of $1,212,500 minus the adjusted basis. Now we have a gain of $454,500 prior to the exclusion. So if you're single, you'd have a gain of $204,500. That would be taxed as long-term capital gains as long as the sale occurred after 1 year after the purchase. If you are married, you'd have no capital gains to report in this example because, again, it's a negative number of $45,500. So side note is if your spouse passed away and you held title as a community property, then you would be able to get a full stepped-up basis at the time of death. So if the fair market value of the property at the time of death is $1,300,000 at that time, that becomes your new basis. Then, as a single filer, you'd be able to have an additional $250,000 you could exclude on top of the $1.3 million if you just decided to sell. Now, if title was held as joint tenants, you'd only get a half-up, stepped-up basis or $650,000 of the spouse that passed away, plus the initial one-half basis of the surviving spouse, which would be $250,000. So the surviving spouse new basis would be $750,000 in that case. So the tax benefit is a really good reason to hold title as community property. So now you know how to calculate your potential gain when you sell. Of course, if you like this content, give it a thumbs up or leave a comment below. Thanks.